If the United States is going to go to a gold standard, what would the price of gold have to be to avoid a deflationary collapse? So if you took M1 and you said, I'm going to back it with 40% gold, and here's how much gold I have, which is 8,133 tons, what would the price of gold have to be to equate to 40% of M1? And the answer is $27,000. If gold repeated the performance it gave from 1971 to 1980, in terms of the percentage decline of the dollar, gold would be $100,000 an ounce. If you replace 71 to 80, starting from 2 years ago, gold's $100,000 an ounce. That's not my forecast, but that's the math.
Gold is entering a powerful revaluation phase as the global monetary system strains under accelerating debt, declining confidence, and rising pressure for a credible anchor. The relationship between the money supply and gold backing suggests an equilibrium price well above current market levels. When measured against modern M1, historical reserve ratios, and past periods of dollar erosion, the proper valuation gap becomes impossible to ignore. Jim Rickards, a leading strategist in monetary economics, emphasizes that simple math explains why gold's repricing could be dramatic. A return to a 40% backing of M1, the same proportion the US maintained during its strongest monetary periods, implies gold above $27,000 per ounce. But if gold were to repeat its 1971 and 1980 performance, matching the percentage decline in the dollar seen in that era, the implied target would reach $100,000 per ounce in today's terms. This isn't a forecast, but a mathematical benchmark revealing how undervalued gold becomes when confidence in fiat weakens. Silver, with both industrial and monetary demand, naturally accelerates alongside gold and often outperforms once a major gold bull cycle is confirmed. Meanwhile, steady central bank accumulation establishes a soft floor beneath both metals as the global system prepares for a structural reset. Now, we present the clips from Jim Rickards' interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Yeah, I've got gold going to $10,000, which at this point is, I'm not giving a lot of thought to it and followed it for a very long time. That's kind of a commonplace projection. You know, you go on the web and podcasts, everything, yeah, gold's going to go to $10,000, et cetera. So, you know, what's the value added in that projection? I would say that it's going to hit $10,000 a lot faster than people think. And there are some interesting reasons for that. I mean, we can go into the fundamentals and explain why gold's going up. I'm happy to talk about that. But in terms of that price target and getting there, probably in 2026 and maybe not even that far into the year. I always like to keep the math at the 5th grade level, at least when I was in 5th grade. You know, but there's a behavioral psychological phenomenon called anchoring. And the idea is you get an idea in your head, it could be a number or theme or whatever, and you anchor on it, and then you begin to filter all the data you're getting through that anchor, and it can change, but that's a very, very common phenomenon. So people will look at gold, and they'll have a number, let's just say $1,000 an ounce, so it goes from, you know, $2,000 an ounce to $3,000 an ounce. Now it's made its way to $4,000 an ounce. And that took a while, it took a couple of years. I mean, percentage-wise, these are good gains, but that took a couple of years. So they go, oh, well, $10,000, it seems like the dark side of the moon, it's going to take forever to get there. But the math is that so if you have 50 ounces and it goes up $1,000 an ounce, you made $50,000. Okay, it goes up another $1,000 an ounce, you made another $50,000. So you're anchored on the $1,000 steps and the $50,000 you made, which is all true, and that doesn't change. But when you go from 2,000 to 3,000, that's a 50% gain. When you go from 3 to 4, that's only a 33% gain. Well, when you go from 9 to 10, that's only an 11% gain. That's like a good month the way gold's been trading lately. So the point is, people kind of lose sight of that. So yeah, 3 to 4 made it, 4 to 5 getting there, but you're going to go 7, 8, 9, 10 really quickly because those are smaller percentage gains.
Yeah.
And that's something that people, you know, they extrapolate 2 to 3, how long is it going to take to get there? The answer is probably not very long. If the United States is going to go to a gold standard, what would the price of gold have to be to avoid a deflationary collapse?
Ah, okay.
And so it, again, simple math. So when we had a gold standard, so you know, the Austrians banged the table. It's got to be 100% back gold, or else, you know, whatever, it's leveraged. The truth is, the British maintained a very good gold standard, very powerful in the 19th century. They had about 20% gold. Up until the 1960s, the U.S. maintained a gold standard with 40% gold. Now, 40% gold compared to money, how do you define money? So you've got a M0, M1, M2. I mean, the Fed can't define money. They got like 5 flavors. So I use M1 because I think it's practical. So if you took M1 and you said, I'm going to back it with 40% gold, and here's how much gold I have, which is 8,133 tons, what would the price of gold have to be to equate to 40% of M1? And the answer is $27,000. So that's not a forecast, but it's a way to think about what gold is really worth in a world where people are losing confidence in the dollar. And you do have to go to a gold standard or something, some kind of peg. That's the lowest price, and that price keeps going up because M1 keeps going up. Silver is more difficult to analyze than gold because it has both characteristics. It's an industrial input. So leave aside the precious metal monetary aspect of it. It's industrial input. If the economy is slowing, kinds of things you talked about in Germany and Japan and elsewhere, maybe they need less silver, maybe they're making fewer automobiles, et cetera. So that's kind of a drag on silver. On the other hand, it is a precious metal. There's no way that gold's going to 10,000, which I expect, where silver's not going to 100 or 150. I mean, it's along for the ride.
Huge move.
Number one, that's exactly right. So number one, so gold's going up and silver's along for the ride. I think that's a given. There's no way gold's doing what I expect and I can see that silver doesn't. But in addition to that, silver might actually be a better form of money. Now store wealth is one aspect of money, and gold and silver have that. But in terms of currency, something you could actually use.
Yeah.
So 1 ounce gold coin, $4,000. That's a lot of groceries. I've actually been buying. Well, in a world where the power grid's down, society's falling apart, et cetera, and you might actually need to use silver or gold to feed your family. Silver is much more practical, and always was the money of the United States. Yeah. The U.S. didn't have a gold standard until 1900. I mean, it was McKinley. Now, gold was always around, and yes, it was a form of money. And you had the 1869 frenzy, with gold and Big Jim Fisk. But it wasn't money until 1900. But silver always was. And an ounce of silver, that's a week's worth of groceries, or a shopping trip. I always recommend having a monster box. Now, a monster box is 500 1-ounce American silver eagles. It's from the U.S. Mint. I'm not dinging private mints, but this is the real deal. U.S. Mint. It's a U.S. coin. In God we trust. They're in sleeves, 20 sleeves, and 25 of them. So 500 1-ounce silver coins, and there's a compression strap around. Don't cut the strap because that's your seal of approval. Yeah. It hasn't been opened or touched or whatever. Gold is now what I call an asymmetric trade, which is it has, and this goes back to central bank buying. I said there was a driver, and it is a driver, and it's going to continue. But central banks are actually pretty smart buyers. I hate to use the phrase "buy the dips," but they don't want to. They don't want a frenzy. If you're not done buying gold, you don't want the price to go up that much. You kind of like it where it is. We can shoot in more. So it's like Russia did a very good job of this. They had standing orders in London, 10 tons a month, just shoot it in. We don't want to buy 100. Actually, you can't buy 100. We don't want to go away. Just steady Eddie, and then the market could adjust to that. So they got their goal without spiking it. But they're going to, they're going to keep doing that. But the point is, it puts a soft floor. No guarantees, but it puts a soft floor under the price. So you got all the upside, which is quite high, but it's unlikely to crash because the central banks will step in and buy. If gold repeated the performance it gave from 1971 to 1980 in terms of the percentage decline of the dollar, gold would be $100,000 an ounce. If you replace 71 to 80, starting from 2 years ago, gold's $100,000 an ounce. That's not my forecast, but that's the math.
Rising geopolitical tensions, sanctions, and financial uncertainty are reshaping global reserve strategies as central banks increase their gold accumulation at the fastest pace in modern history. Since 2010, net buying has reversed 4 decades of net selling, driven not only by traditional players, but also by Middle Eastern and Asian institutions seeking to insulate themselves from currency seizures and political risk. The decision to freeze Russian reserves shocked many nations into reassessing the safety of their foreign-held assets, accelerating a shift from paper instruments to domestically held physical bullion. At the same time, supply growth has stagnated, with mining output hovering near the same levels for 6 years, while extraction costs rise steadily. This creates a structural imbalance where stable production meets expanding demand, pushing prices upward. Against this backdrop, gold has evolved into a broad-spectrum hedge, resilient in the face of inflation, deflation, conflict, or systemic stress. Now, let's get back to the interview.
Number one reason, central bank buying. Now,
Yeah,
that inflection point was 2010. But from 1970 to 2010, central banks were net sellers. 2010 was the year when they became net buyers. Now, not the same central banks. Russia and China are buying, and before, Switzerland, UK.
Do you care who's buying? Because you're looking at the net number.
No, I don't care. I care if I'm doing geopolitical analysis, but if I'm trying to analyze gold, no, it's a fundamental.
Because I can tell you right now, my new Middle Eastern clients, big buyers. All they want to talk about are how big.
Right. Well, let's just talk about Russia for a second, because it's interesting. Vera Nabulina is the head of the Central Bank of Russia. I've said she's the only central banker in the world who actually understands her job. She's good at it, unlike the rest of them. So 2022, Russia's special military operation comes into Ukraine. So Biden throws every tariff, and a lot of the work I did for the intelligence community was on sanctions and financial warfare. So I knew a lot about it, and I knew the statutes and all that. So every sanction you can think of, that we're not buying your exports, not buying your oil. They still are, by the way. They say this. They're still buying a lot of it. And so we're just going to. Biden said, the ruble will be rubble. That was an exact quote. Et cetera. We're going to destroy the Russian economy, and all that. And they froze $200 billion of U.S. Treasury securities that Russia had lawfully acquired, or were on deposit Euroclear.
Mm-hmm.
They were in custody at Euroclear. Let me come back to that in a second. But there are a lot of reasons why the Russian economy did not collapse. One of them was she put 25% of their reserves in physical bullion.
Yes, that's right.
And so their reserve position, their reserve position was about $600 billion at the time. $150 billion was in physical gold. Again, in Moscow, not something at the Fed or anything like that. And she's been working at, which is, by the way, what we told the Pentagon in 2009. We said, this is what Russia's going to do. And they did it. Now, two things. Number one, that prevented their a run on Russia, and run on the central bank, in other words, because they had those assets. Number two, and this is my favorite part, because the U.S. and EU have threatened to steal, I use the word steal, the $200 billion at Euroclear. That's one of the reasons the gold price is going up. Because if you're Saudi Arabia or Taiwan or Iran or Turkey or anybody else, Brazil, and you're watching this happen, you're like, hey, what if the U.S. doesn't like what I do? Are they going to freeze my treasury securities?
Yeah.
Maybe I better get some gold. Not 100%, but at the margin, they're all buying gold partly as insurance against the U.S. stealing their U.S. Treasury securities. And Russia has made about $100 billion in mark-to-market profit on the gold. So here we are trying to steal the $200 billion, but they've made, because the price of gold has doubled, so they've made over about $150 billion in mark-to-market profits on the gold. So they're getting their treasuries back in a different form, which is the stupidity of the U.S. sanctions. But that's one of the drivers of just central bank net buying in general, and threats to steal the Russian securities in particular. Now, what's that plan? This Ursula von der Leyen, she's the head of the EU, and Kaja Kallas, they don't have a defense minister, but she's or foreign minister, but she kind of postures that way. So they're the leaders of this. So this, and the lawyers are involved. So here's the latest. We're not actually going to steal the Russian money. It's frozen. It's locked up. Russia can't get it. But usually when we freeze it and then the war's over, sign a treaty and get your money back. But we're going to take it as collateral. So we're going to make a $150 billion loan to Ukraine. The loan will be repaid with Russian reparations when Russia loses the war. But it will be collateralized with the Russian assets. So Russia loses the war, pays reparations, pay back the loan, and the assets are still there. Everything about that is false, meaning, first of all, Russia's not going to lose the war. They're winning the war. Russia's not going to pay reparations. They'll probably extract, well, they already are, from Ukraine to pay themselves reparations. The loan's going to go into default, and you'll have to go to the collateral, at which point you've broken every contract, every law you can think of. Now, Russia, which actually understands this stuff, is going to sue. If this happens, I think they'll actually, someone will get the message and say, not a good idea, but if they go ahead with this, and those assets are converted to repay this loan to Ukraine, Russia's going to sue Euroclear. Now, Euroclear, based in Belgium, but they have offices in Dubai, Hong Kong. You don't have to look far to find a friendly jurisdiction. So Russia sues Euroclear in a Hong Kong court. Euroclear has $47 trillion of assets in custody. So you're going to throw a cloud and a potential freeze on $47 trillion of assets when Russia gets a judgment saying, yeah, you owe this money to Russia, Russia can go around freezing Euroclear assets in every jurisdiction they can find, starting with Belgium, and that's like DTC. I mean, Euroclear is like DTCC. You don't mess with it. It's the core of the system. So, but see, what I just described has like 5 moves in it. These people can't think 1 move ahead, let alone 5. But that's where we come to. And what kind of treatment is Russia going to get in a Hong Kong court? Very favorable, I would suggest, because it's controlled by China. So, so what are they thinking? But they are. So, but okay, that's an aside. Russia's biggest mistake was trusting the United States. But anyway. The point being, with all this going on and all these clouds and all this uncertainty, why wouldn't you have gold? So central bank buying, number one, but with a lot behind it, which we just talked about. Supply has been flat, about 4,000 metric tons per year for 6 years. Now, I'm not saying peak gold. I'm not saying you can't find a gold mine anywhere. I mean, I invest in some gold mines, but privately, but it's flat, and demand is going up because of central banks. So, supply flat, demand up. What happens to price? It goes up.
Yep.
So that's a driver. So there's the
that's easy.
Yeah, right. So stealing the Russian assets is a driver because central banks are concerned that we'll do it to them, so they want gold. Supply and demand. That's central bank buying. Supply and demand. Supply is flat. It's getting harder. Again, not saying peak gold, but it's really getting harder and more expensive to find the gold mines. There's the math we talked about, which is that these, whether it's $100, $1,000 they get easier. They just get easier. Again, you got to we don't think about logarithmically. That's different, but that's another driver. And gold is really, I don't think of it as an inflation hedge. It can be. The correlation is actually not as high as most people assume, but I call it the everything hedge.
Yep.
Inflation, deflation, social unrest, war. Natural disaster, legal problems, kind of things we talked about with Euroclear and Russia. Gold is not vulnerable to any of those things. And then you got more extreme cases. How's your Bitcoin doing when the power grid's out? Questions like that. The Economist, the Financial Times, New York Times, Washington Post, a few other big publications, leaving aside what they get right about economics, which is not much. Their hatred of Russia. And if those were your sources, you would say the war's a stalemate, Russian casualties are piling up, Putin's on the verge of collapse, keep it up, give me a few more weapons, etc. Everything I just said is false. Russia's not on the verge of collapse. They're on a war footing. They've mobilized their economy. The biggest economic problem is labor shortages because everyone's working. Nebulina's doing a really very good job on interest rates and inflation. The ruble is right where it was in 2022. When it crashed and then it came right back and is very stable. And they're making lots of money in oil and natural gas exports. Now compare that to Germany, which is committing economic suicide. I don't know a better way to describe it. But 14 years under Merkel, they closed every coal-fired plant in the country, every one. They closed all but, I think, 2 nuclear plants. They spent enormous resources on windmills and solar panels, and they were really only running on one thing, which is Russian natural gas, and they blew up the pipeline. They blew up the Nord Stream pipeline. So now they're in free fall. I bought I like Audis. I bought a German car about a year ago, and I'm really particular about it because all my friends with Mercedes, they go, I got a nice German car. It's like, no, it's made in South Carolina. If you want a German car, you got to get an Audi. But I read all the specs, and I really care about this stuff. And I got the car, and I read the specs, and I saw the engine was made in Hungary. I was like, I was okay with that. The Hungarians are smart, good engineers. I didn't have a problem with that. But I thought, why is the greatest automotive power in the world outsourcing their engine production to Hungary? And the answer is energy costs. It's one of the biggest inputs. And German energy costs are through the roof. Yeah. Guess who's buying Russian oil, Russian natural gas? Hungary and Orbán. So they got their costs lower, and they got the job of building the engines. But this goes to the other big industries in Germany: chemical production, steel production, automobiles, manufacturing, engineering. They all depend on energy inputs, and the cost of energy is going through the roof because they shut down all the energy and then blew up the pipeline. So how do you describe that other than suicide?
global reserve behavior is shifting rapidly as nations reassess the reliability of traditional financial assets and the risks of external custody. The freezing of foreign-held reserves, rising geopolitical tensions, and growing reliance on sanctions have pushed many countries to diversify away from vulnerable instruments and accumulate hard, unconfiscated stores of value. At the same time, mining output remains flat while the cost and complexity of discoveries continue to rise, creating a structural environment where demand steadily outpaces supply. These pressures intensify as energy-driven manufacturing slowdowns ripple across major economies, exposing the fragility of industrial systems and raising concerns about long-term stability. In this environment, gold is increasingly treated not as a speculative asset but as a strategic foundation, an anchor capable of withstanding political shifts, energy crises, and financial turbulence. Its role as a universal hedge grows stronger as global uncertainty widens. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.